Right now, the global economy is in the jaws of a severe supply shock. The conflict in Iran and the closure of the Strait of Hormuz have bottlenecked one of the world's most critical shipping arteries. Historically, a disruption of this scale triggers immediate panic. We expect to see sharp economic slowing, skyrocketing costs, and a massive pullback in global investment. Yet the real-time data shows the opposite. Purchasing manager indexes, economic surprise indexes, and global equity markets hold steady. This chart shows the recent revisions to the 2026 global growth forecast. Despite the shipping crisis, analysts have only dropped their projections from 2.9% in February down to 2.6%. That is a remarkably minor correction for an economy absorbing a massive oil shock. This resilience has left market analysts in a wait-and-see mode. They are watching for signs of a sharp slowdown that, so far, simply hasn't materialized. The global economy is currently overriding the drag of energy prices through three specific regional growth engines. Right now in Asia, the ongoing AI boom is currently driving a massive wave of new physical infrastructure construction. NVIDIA is now operating as a full-scale AI factory, supplying hyperscalers with the Blackwell systems and networking fabrics needed to run the next generation of models. The primary challenge has shifted from software to data center execution. To keep up, companies are making aggressive upstream reservations, locking in billions of dollars in capacity for chips, optics, and system components years in advance. This booking strategy secures the entire Taiwanese tech supply chain. The volume of orders provides long-term visibility and financial stability that didn't exist in previous cycles. We can see the priority placed on this momentum at Samsung Electronics. When a labor strike threatened to stall production recently, management and the union reached a rapid tentative agreement on wages and bonuses, specifically to keep the DS division running. The capital expenditure required for AI infrastructure is so vast that it creates an economic engine strong enough to outpace the rising costs of energy. Our second engine is in the Middle East. Under the Saudi Vision 2030 strategy, the government is working to increase the GDP contribution of small and medium-sized businesses. Local institutions like Riyadh Bank and the Saudi National Bank are pivoting their entire strategies to support this, scaling their customer bases to lend directly to these local enterprises. This graph shows the projected growth of that strategy, plotting a 15% compound annual growth rate for small business lending through 2029. By that period's end, these loans will grow to comprise 14% of the total loan portfolio for banks in the region. By fueling internal business growth, these emerging markets are building local economic shields that help insulate them from external global shocks. In Europe, established corporate defenses are repelling market disruptions. For example, Chase recently entered the German retail market with a highly aggressive 4% deposit rate. A teaser rate that high should logically cause a massive drain of customers from local incumbents as they chase the higher yield. However, as this diagram illustrates, players like ING are holding their ground. Their customer base is staying put despite the new competition. This is the result of a sticky mobile primary customer base. By converting users into primary digital accounts, banks anchor them in place, making it less likely for them to switch providers for a short-term financial offer. These digital moats allow companies to withstand sudden market pressures and aggressive foreign capital without losing their core business. All of this returns to our central question: how has the global economy survived the Hormuz supply shock? This matrix shows the pillars supporting the market. Resilience is coming from relentless AI capital expenditure, emerging market diversification, and the digital moats of major corporations. While analysts remain cautious, the current data shows that the economy is successfully absorbing these shocks by leaning on its strongest growth sectors. The modern global economy is finding balance by relying on localized micro-engines, which maintain momentum even when traditional trade routes are under pressure. This video is only for financial analysis and does not constitute any investment advice.